When you see that the market is going up, there are 3 patterns that can improve trade quality to see that the market continues in going in that direction. The first one is, because it's a 1-minute chart, the red and a green candle, the lowest wick as you see here, from number 1 to red and green, number 2, the lowest wick. Check this out, red and green here, the lowest wick here. So 1, 2, 3, you can see it goes higher. The next red and green with the wick is here, 4 goes higher. The next red and green is here, lowest wick here, 5 goes higher. And that shows us that majority of red and green, actually every red and green, the lowest wick from the signal goes higher, what shows us that the market has an uptrend. The second pattern is from red and green, we concentrate not on the lowest wick, now we concentrate on the candlestick body. As you can see here, as you can see, sometimes some people take the red candle, some the green. I always love to take the green one, but in this example, I'm going to take the green one because this is the most easiest one, that if you have a color switch of red and green, just take the lowest candlestick body. You see a red and green, red and green, red and green. Now you have 1 to number 2 goes higher, but number 2 to number 3 goes also higher. But now check this out, number 3 to number 4 goes lower. But number 2 to number 4 goes higher. Number 1 to number 2 and 4 goes higher still. That means if you have like a signal and it says to you, it goes up, it goes up, it goes down, it goes up. The majority, we have right now 3 times a signal that it goes up, but there's this faulty signal that says just like it goes down, and it's to prioritize what makes sense, that we still assume that the market goes up. And it all breaks down also, and this is something what's very important, if the market reached already a specific target, such as a bigger or lower structure high or low, then it is, for example, here, this high that you see here on the left side, and here's also a high that you can see on the left side. We cannot see it right now on the very left side because we would need to zoom out and search the day, for example. But those are bigger structure or medium structure highs on the left side. And if the market touched it and still does a lot of green candles, then it makes sense that the market continues up here. So until the market touches one of these blue lines, the signal makes a lot of sense. The third thing is to take all the wicks. That means if you can see from red and green, check this out, from the red to the green candle, the wick has here the same. You also have three kind of directions. The one is the one that is in the middle. It is just like a double bottom. The other one is the higher low, as you can see here, higher wick. And the other one is a lower low. This also applies, by the way, to highs. I think it's very important when the market is going up to concentrate only on the lows, to prioritize them mostly. And when the market goes down, to prioritize on the highs. So we're going to prioritize here now the lows only. We're not going to read the highs because I think it's too advanced. It's something even unnecessary is what I see for beginners. They don't need to concentrate too much on the highs. It's literally the lows first. You see here, when you look here at the wicks from the first green here to the red to this green here, that the wick was getting higher. And then it did here a double bottom, it's called here, on the same length here. And this shows us that the market was going up here. Now check this out. From here to here, the wick is going higher. Here it is again like the double bottom. Now it goes one time lower, and now it goes one time bigger, higher. So it shows you from here it goes from 1 to 2 it goes higher, to 2 to 3 it goes higher, to 3 to 4 it stays the same. That's actually pretty good because the market was going up, and then just because the market stays the same, we can still expect that the market continues to go up. And then now, just because there's this one signal that it goes lower here, what do you see here? I mean, it is literally to ignore that because the next one goes higher again. So it's literally about to see like goes up, goes up, goes up, goes up with the signals, then one time it going down, going up, and then still assuming the market still will continue to go up. These are 3 methods to read pressure. A very big struggle is the trader is concentrating too much on that. What is also to add additional, to prioritize actually, can we see right now that the market is going to our references? That means we have here, for example, a bigger structure high, and we have here a bigger structure low. And there are days and sometimes weeks, 1 or 2 weeks, where the market is just wiggling around. It looks on the left side like this, and it's hard to identify if the market wants to go to number 1 or 2. If we have a day that is trending and the market is trending up, and we can see in combination within 15 minutes the market was doing these lengths, like more length up than length down, then I think it makes more sense that the market reaches now here target 1 than target number 2. And this is exactly where these 3 methods can be efficient. This is market reading in identifying in what direction the market is going. So additional, I would like to give you something where these 3 steps, what I just gave you, these 3 methods of candlestick reading can help a lot. The first one is to understand that if the market does more green than red candles, or more red than green candles for going down, more green candles for going up, of course. The second thing is if the market does more length up than more length down. This is something that's also important. So it's more one-sided. The third thing is if you see that the market is wiggling around, like does more consolidation phases that are higher, as you see here, and then here does way more candles, it shows you the market wants to have more time on higher prices, and not every time, but mostly also more volume higher. What shows us also that the market also wants to go higher. We say always in trading that when there's a consolidation phase, and especially they're dangerous to trade, especially in the middle here. But if we can see that the market is pressing up from bottom to top, it actually even would make sense sometimes to trade here inside if the market starts to make a lot of green candles, or had a spike in the middle, was going down, and then starts here to press out. It makes a lot of sense then still to trade in a consolidation phase when we see that the market is pressing. I'm going to show this to you now on the practical side. That means here we can see a consolidation phase. We need to make this one off, then we make this one on here on black. And you can see here literally, here's the consolidation phase. It's a bit dangerous. And when looking on it, you can see from the bigger structure now also that here it does a higher low. So number 1 to number 2, it goes higher. And then to number 3, it goes higher. The trader, the student here started to trade in this area here on the right side. That means we can read on the past, on the left side, it was going from 1 to 2, from 2 to 3, it was going each time higher in structure. And we can also read that down here there were less candles, up here are more candles than down here. So number 1 had less candles, number 2 had the most candles, number 3 has less candles, and number 4, check this out, has again a lot of candles. So you see how the market shifts up by having a lot of candles here. Even here, number 5 here has a lot of candles, what shows us just the market likes to trade for higher prices. What we can use sometimes even to trade in this area, still trading up. What I just don't like, because it was the actual high of the day, and above the high of the day, I think the current high of the day, I think it's not good to trade it in general. I think it's always what works out very well with the market, because the market is choppy a lot. That means just like in a consolidation phase, I mean to say, just like getting back and forth. I think it's always way more better to understand those are bigger structure highs. These lines, what you see here on the left side, that means this is a bigger structure high, this is a bigger structure high, this one, and here we have a big structure high. So we have 1, 2, 3, 4 targets for the market, what we see here on the right side. And then when the market starts now to wiggle higher, does more length up than more length down, as you see here, for example, you see more length up than down. Then it is, I think, to use these methods to read red and green goes higher, red and green goes higher, and then just to take this, please use a demo account, of course, not a real money account. When having now a small green candle that is small enough and adjusting here $100 to get $500 out, that means like buying so much after a small green candle closes that when it goes against us under this green candle, we enter the trade after the green candle. When it goes under the green candle, we lose $100. This can happen within 2 seconds, 1 second or 5 seconds. But if the market goes in our direction, then making $400, $500, $600, $700, depends on how good the trade is running, how far our target here is away. I think the ratio of 1 to 5 is very important. It means seeing a candle that is so small when adjusting $100 to our target that it would be minimum $500 in average. And it is also important to understand, sometimes we have days where the market is not running well, but sometimes we have days where the market is running very, very well. And I think it's, of course, sometimes also brutality to have to trade way more aggressive in that direction. And I hope you can take something out of this video and you can use this for your own trading.